the remainder of the slides here for chapter 4. Okay, and we had kind of finished up with the dividend discussion, and then we were coming up on income received by an agent. Okay, and so when you think of an agent, just think of yourself as, you know, movie star or sports icon or something. What happens? You hire this agent, and your agent goes out and does things on your behalf, right? But the principal, that would be you in that sample, the rock star or whatever, controls the agent. So from the tax perspective, since the principal controls the agent, then any monies that are collected by the agent on the principal's behalf are considered what? Income of the principal, right? You can't say, well, my agent collected that, so that's his or hers taxable money. No, we would sit there and consider that to be the income of the principal. Okay. All right. Let's go ahead, and nothing terribly complicated there. Okay. I guess we can go ahead and highlight that, right? Which is basically the point that I just stated. Okay. All right, good. Let's go ahead then and take a look at income from partnerships. And I forget, what was the name of the lady? Was it KPMG? She was sitting right here, Vivian. Okay, she was talking about how she specialized in tax through pass-through entities. Okay, and we're going to look at this more in some of the later chapters, but let's just go ahead and give ourselves a sense of some couple of typical pass-through entities. One being a partnership, and then the other on the next slide here being S corporations. What happens? The entity, the business, the partnership passes the income onto the individual. So instead of, in a case of partnership, instead of, say, the corporation or the partnership paying tax, what? The partners themselves pay tax. So it passes through to the actual individuals that are the partners. So the partnership will still file a partnership return, okay? But each partner reports their distributive share of income and deductions, okay? And it is going to be reported in the year that it is earned by the partnership, whether or not it is actually distributed. So that's a little bit different than what we've been saying for tax basis taxpayers, cash basis taxpayers. Usually it's in the year that they receive it. Doesn't matter. It does not have to be distributed in order to be considered income. So we have this Tara owns one half of the interest in a capital, in the capital and profit of T&S Company. And for tax year 2017, the partnership earned revenue of 150, had operating expenses of 80. During the year, Tara withdrew 2,500 per month for a total of 30,000. Guys, that is a distractor. That is irrelevant. That has nothing to do. No, I'm not yelling at you. I know I'm a little intense, but I'm not yelling at you. It's just I'm just saying, it is, obviously you're not paying attention also. It has nothing to do what you would draw. That's a distractor, okay? And then we say that for 2017, Tara must report what? 35,000 as her share of the partnership profit. She's a half owner, and the revenues were 150, the expenses were 80. The fact that she received distributions of 30,000 are not relevant to this, right? It's simply whatever her share was of the earnings of the partnership. Okay. All right, good. Let's take a look at the next slide. And we talk about S corporation here, another example, popular example of a pass-through entity. Again, the idea here is that the S corporation does not pay the tax, the small number of shareholders do. And we'll get into the number of shareholders, et cetera, that allow you to be an S corporation. Now, sometimes the question will come up, well, why would you go for S corporation when you could be a partnership if, again, it's going to just be the income being passed through to the to the shareholders? And the answer is they're probably looking for some sort of limited liability that you would receive with a corporation versus partnership form of business. Okay, so we take a look, and again, just like it was for the partnership, income flows through to the shareholder. By the way, S corporation is subchapter S. Remember, we said we usually refer to the section, but then there are some times that we call out the subchapter. Okay, so it flows through to the shareholders rather than the corporation, and the S corporation shareholders pay the tax on the corporation's income. Okay, and they tell us that generally what will happen is the shareholders will go ahead and report their proportionate share of the S corporation's income and deductions, again, even if there is not an actual distribution. So very similar to what we've said about partnerships here, right? But we've just got a different form of business, the S corporation. Okay, take a look at income from estates and trusts, and generally we are taxed on the distribution. Okay, generally taxed on the income earned, I should say, by the estates or trusts that is actually distributed or required to be distributed to them. Okay, any income not taxed is taxable to the estate or the trust. So if we don't actually pay the tax through the individuals, then the estate or trust. And we'll get into a little bit more estate and trust later. Okay, estates sometimes have to actually file a return, or the trust will have to file a return, and in some cases they may have to pay the tax. Okay, all right, let's take a look at community property states. And we have certain community property states, California being one of them. Okay, and then you could choose to be a community property state. If you're in Alaska, you can choose to be treated as a community property rules, use the community property rules. All other states have what they call common law. Okay, basic difference between the common law and community property states centers around the rights of married individuals. And so what we're going to see is that that's the primary difference. And what we're going to see, questions about community property and how to handle it for our community property states obviously will come up when you have the issue of the married taxpayers filing separate. Okay, and so we're going to see that we're going to have to consider those differently, and after all that I still ended up with the yellow. Okay, does anyone know how to use PowerPoint so I have a palette of colors that I can just choose from right there? Does it have such a function? I'm sitting here and I keep asking that question and no one seems to be able to answer it. It's just a funky process where you have to go in, instead of some software give you the choices of pen, highlighter, and you think that PowerPoint would be like the king of that. I can't understand why they haven't done something about that. Anyway, okay. Enough about PowerPoint. So let's go ahead and let's take a look at what the rules are. And under community property, all property is deemed to either be separately owned by the spouse or belong to the marital community. If the property belongs to the marital community, we're going to see that what? Any income from that property is going to be considered community income. It'll be half to each. If it's what? A separate asset that somebody has, then it is going to be considered a separate income. And again, it only matters if you're filing separate, married filing separate. If you file a joint return, it all goes on the joint return, right? Okay, so we'd say that property may be held separately by a spouse if it was acquired before the marriage or received as a gift or inheritance following the marriage. Okay, so you can hold some property separate from your spouse if you had it separate before the marriage, or if they received that property through some sort of inheritance, even though you're already married, they could keep that separate. Okay, otherwise, any property is deemed to be what? Deemed to be community property, and thus the income from that will be considered income half to each member of the community, of the marriage, essentially. Okay, all federal tax purposes, each spouse is taxed on 1/2 of income that belongs to what? belonging to the community. Again, pretty much just a marriage. I mean, we're using the term community here. Uh-huh. I mean, the rules apply. They only become relevant if we're married filing separate. Because if we're, if the two people are married filing jointly, everything's going to be reported jointly anyway, right? The person A's income, person B's income is all going to be reported on the joint return anyway. So even though it legally could still be separate income, from the tax standpoint, the only consequence is if two people file married filing separate. Okay. Okay, so we take a look, and all properties is deemed to either be separately owned. Okay, that's right. Either separately owned by the spouse or belong to the marital community. Community income is allocable to each spouse. Now, the answer that I just gave you is relevant to California, okay, because we're talking about Texas, Louisiana, and I don't know why they didn't just go ahead and include Wisconsin was the other state here. Okay, separate income may produce community income. So even though the property is separate in these states, they'll still treat that income as belonging to the community. So some states got a little bit of a different approach, and therefore the tax consequence is different. Okay, there is no allocation of community property, and again, this gets into the filing separate issue and why we care if the property is separate, is owned by one individual. The property is separate. No allocation of community income for some spouses living apart for the entire year, and again, the point being filing separate. Okay, so you come over and you take a look at this example. Where'd my example go? Oh, here we go. Sorry. We're still on this. Sorry, guys. The laws of Idaho, Louisiana, Texas, and Wisconsin, I guess Idaho is in there too, can separate property and income it produces. In these states, income from separate property belongs to the community. Accordingly, for the federal tax purposes, each spouse is taxed on one half of the income. In the remaining community property states, if the property is separate, the income is separate. And again, of course, if we file a joint return, then all the income is just reported on the joint return. There's no real consequence there. Okay. Take a look at recovery of capital here. Let's say one spouse gets the house and the other one gets some stock or something, and they split up, right? And there's a divorce. There's no taxable consequence of that. Okay, so you don't have to pay tax because you got the whole house now, but you will keep the basis of whatever the basis was in the community before it was distributed to you. Okay. Items such as non-taxable dividends, royalties from mineral rights, and gains and losses from the sale of property take on the same classification as the asset to which they relate. So if you got something, and when we say non-taxable, stock is a stock dividend. If you got a stock dividend from a stock that was separate, then the stock dividend is also what? Also going to be separate. Okay. So if you take a look at this example, and we've got Bob and Jane reside in California, community property state, and Jane got non-taxable stock dividend based on stock that was given to her by her mother after Jane's marriage, but it is still what? It is still considered separate because it was inheritance after the marriage, right? Then there's a gain of $10,000 on the sale of unimproved land Bob purchased before the marriage. Since Bob purchased it before the marriage, it's what? It's going to be separate, right? I always have trouble tuning out the fact that my brother-in-law's name is Bob, and I start thinking about, okay, what's Bob doing buying this property before he married my sister? No, that should be her property too. Okay, then what? So then we have what? We have these Oil royalties of $15,000 from a lease Jane acquired with her separate funds after marriage. Again, because she acquired that asset with separate funds, the asset says to stay separate. So, because the stock dividend was distributed on stock held by Jane as separate property, it is also her separate property. The same result occurs for the oil royalties and what? All the proceeds from the sale of this unimproved property that Bob had is also what? Also separate property because he held it before the marriage, right? Okay. And again, in all of the community property states, and it's kind of this little tiny thing down here, and you almost think it's an afterthought, but it's a pretty important one. I'll put a star there just so we realize that I'm not trying to minimize it by having it so small down there. In all community property states, income from personal services, salaries, wages, is generally treated as what? Half earned by each spouse, right? Okay, so we have the property in which there's income that could be separated, but in terms of what? Work, the income that is generated from the fruit of your labor, that is always considered what? Considered community property in the community property states. Okay, so let's just take a look. And we have Fred and Wilma are married but file separate return. Fred received $25,000 of salary. Now you take a look, guys, and notice that in our community property states, half of that belongs to, and they're asking us about Wilma here. Fred and Wilma. Okay, so they're asking us about Wilma here, and she's getting what? She's getting half. She is considered to have earned half of Fred's money here, right? Okay. Now you come over, and 300 of the taxable interest on savings account that he established in his name. All deposits to the savings accounts were made from Fred's salary that he earned what? Since the marriage. So you take a look, and the what? Interest is also considered community income because he what? Made all those deposits after the marriage, right? Notice for the common law states, we don't do that. We don't consider it community income, right, for the common law states. Now, Wilma collects $2,000 taxable dividend. Okay, let's make Wilma's stuff green. Wilma collected $2,000 taxable dividend in stock she inherited from her father. Hang on, inheritance, right? So since it's an inheritance, then what? Then we're going to go ahead and for that one, in the community property state, the entire 2,000 dividends goes to who? Goes to Wilma. But in Texas, that was one of those weird states along with what? Idaho and Wisconsin and Arizona, or I forget which states it was, okay? But what? If it's Texas, they have that weird situation where they actually do what? They split the income from separate property, right? And treat that as part of the community. So there's that exception. And then in the common law state, the only money that's relevant to Wilma is the money that's related to her separate asset. Okay? Question? Okay, good. Let's come over and let's make sure we understand when these laws will apply. Question? No? When these requirements will apply. So let's just go ahead and, let's look at this Mason and Lily. I felt sorry for Lily in this one for some reason, okay? Have always lived in a community property state. After a bitter argument, Lily moves in with her parents. I don't know, maybe her parents have a big house and they're nice people, but I just picture she seems to be getting the raw end of the deal here, but whatever. She moves in with her parents where she remains for all of 2017. When Lily files her separate return for 2017, she has to do what? Does she have to include half of Mason's salary? No, she does not, because what? They have lived apart. So we have some rules where you don't have to, claim half of the salary if you meet certain requirements. Okay, so, you don't have to pay tax on half of the earnings if you don't, if you meet certain requirements. So spouse is taxed only on their actual earnings from personal services if the following conditions are met. And we take a look, and The individuals did what? Live apart for the entire year. They do not file a joint return, and what? There was no money being distributed back and forth amongst them. And if they meet those requirements, then they don't have to claim half. That sort of gets us out of the community property rules. Okay? All right, good. Let's go ahead and stop me if you got a question, guys. Otherwise, I'm going to go ahead and roll because I want to make sure we get through chapter 4 today so we can see clear to go over the practice midterm tomorrow. Okay. What time is the discussion again? 11? Same room, right? Okay. Okay, good. So we come over and let's talk about alimony. Okay. Now what happens? There's a divorce, there's alimony, and there's also child support. Okay. What we're going to learn is that the alimony is going to be deductible by the payer and included as a gross income of whoever the recipient is. So there's a divorce, there's alimony. The person paying the alimony will be able to deduct that as an adjustment to the gross income. Meanwhile, the payer is going to have to do what? Have to include that in their, not the payer, the receiver is going to have to include that in their gross income. So we come over and we have property settlements, okay, and a transfer of property other than cash to a former spouse under a divorce decree is not a taxable event. Again, one of the spouse gets the house, the other spouse gets some stock. They don't have to pay tax on that transfer, but they will inherit whatever the basis was at that point, okay? The transferor is not entitled to a deduction and does not recognize a gain or loss on the transfer either. No gain on the transfer, no loss on the transfer. And then we come down and the transferee does not recognize income. Okay, so let's just take a look at this question. Paul transfers stock to Rosa. The cost of the stock to Paul is $12,000 and the stock value at the time of the transfer is $15,000. Rosa later sells the stock, and when she sells it for $16,000. Paul does not have to recognize a gain in the transfer, and Rosa will not have to take the gain until later on when she sells the stock. But notice she does what? She inherits or takes whatever the basis was at the time it was transferred from Paul to Rosa. Okay. Okay, good. Let's take a look at the next page and what makes payments qualify as alimony. Payments have to be in cash. Agreement or decree does not specify that the payments are not alimony. Payer and payee are not members of the same household. Okay, we're not going to work that. Oh yeah, we're divorced, but we live in the same house still. Now I get to take deductions for the alimony and stuff. They're not going to allow that. And there is no liability to make the payments for any period after the death of the payee. Okay, if you're going to continue to pay after the death, then they're going to start to consider it a distribution of some sort of wealth to the payee, obviously, and so they're not going to consider it alimony. Alimony is so a person can live at the level that they were living during the marriage, right? Okay. Okay, so you come over and you take a look, and it's just so we're clear, I think that you guys know this. It's usually the person with the higher income that ends up paying the alimony to maintain that lifestyle that they were living prior to the divorce, right? Okay. Now we come over and we have child support. Okay. Taxpayer does not realize income from the receipt of child support payment made by the spouse. This is because the money is for the benefit of the child, and so the payer is not going to be able to deduct the child support payments because the payments are made to satisfy the payer's legal obligation to support their child. Okay, so those are not going to be alimony. They're not considered alimony. They're not going to be deductible. They're also not income to the child or to the spouse, right? Because it's just money that's being paid for the benefit of the child. So let's take a look, and let's say we're making payments, and we're making lump sum payments, say month to month, and we start to run into some trouble. Well, how much of that payment is going to be alimony? How much of that is child support? Okay, it's pretty straightforward. If the amount of the payment would be reduced due to some future related event, such as the child reaches age 21, dies, let's hope not, marries or something like that, then such reduction is deemed to be child support. So I'm supposed to pay, say, $5,000 a month, but if the kid reaches age 21 or graduates college, whatever it says in there, then what? Then the payments are $2,000. Then what? Only that what? $2,000 would be considered alimony. The $3,000 is going to be considered child support. Okay. Okay, good. In addition, if payments are less than required, they are first considered to go towards the child support as opposed to alimony, and that's because the law reads that way most of the time, that any amounts that are short of the monthly payments first go to what? The benefit of the child, right? Okay. And even if the divorce decree specifies certain amounts that differ from these rules as child support, we will still follow these rules. Okay, so if the divorce decree says something else, we still follow these rules. Okay, so you come over, and under this divorce agreement, Matt is required to make periodic payments of $500 per month to Grace. However, when Matt and Grace's child reaches age 21, marries or dies, whichever occurs first. Okay, I don't think you can. Can you get married after you die? I don't, unless it's that Corpse Bride movie or something. I guess you could. Okay. So what happens? You sit here, and the payments will be reduced to $300 a month. Grace has custody of the child because the required contingency is cause for a reduction of the payment from 5 to 3. The child support is what? Must be $200 a month, and only the alimony is $300 a month, and so he can only deduct what? This guy, what's his name, Matt, can only deduct $300 per month as alimony. Okay, all right, so those alimony rules are pretty easy, right? Okay, the hard part is just going through the divorce, right? But at least you know what to do with your taxes after that. Okay, all right, so let's, yes. Is that the new law? I'm not sure. I'm not sure that it is the case, but if it is, you're asking me why? I said to my dad this morning that the tax law is full of politics and prejudice. Okay, so, I guess they don't want you to get divorced? I don't know. I'll have to look that up. Is that what you heard, that they don't allow you to deduct alimony anymore? Well, you don't have to look at it right now. I'll look it up. But I'll see if there's some justification for that. Remember, when they vote on these tax laws, they sit there and they're trying to get what? They're trying to get as much revenue as they can, but they're also trying to get the states to vote for it. And you have some states that, marriage is sacred and all that kind of stuff, which, I mean, I guess it is. I don't know. I'm not married, so I don't. But, with all that, that could be the reason. But I can look into that, first confirm that that's the case, that they're taking that away, and then try and understand the justification, or at least what's been said about it. Okay. Okay, good. Come over and take a look at imputed interest on below market loans. So what happens here? I go ahead and I lend out some money, and I lend it to, say, a kid. And I say, well, I still own the cash. The cash is still mine, but the interest is yours on this deposit, whatever. Well, the tax law looks at that and says, well, the only reason you did that was to pass the interest income on to what? Someone in a lower tax rate. So what they're going to do is they're going to make me impute the interest. They're going to make me use certain statutorily declared rates, federal rates, and I'll have to calculate the interest using those rates that I would have earned, and then I have to pay the tax on that interest. Okay? Now, the sort of common pitfall to think about here is that you keep thinking that the person who got to get the interest is the one who pays the tax. It is not that person. It is what? The one who lent the money supposedly and let the other individual collect the interest on that. That is the person who has to pay the tax. Okay? So let's just look at this Kareem, who's the father, and in a high tax bracket when you combine his state and federal. The Vienna is the daughter, and her rate is 20%. Kareem has $400,000 that he does not need, whatever that means. Okay, so why don't he just burn it then? Okay, and Vienna could use the income from Kareem's excess cash. Before 1984, they could make this transfer, and that would be it. Vienna could invest the cash, and the income would be taxed at her rate. And then in 1984, they changed the law. I don't know why we care about 1984. Were you guys even born in 1984? Okay, thus the income that Kareem could have earned on the $400,000 that could be taxed at 50% would go at Vienna's 20% rate. Okay, I see. They're trying to explain as to how it was. So now we're going to avoid situations like this. Interest is imputed using a federal government statutory rate when a loan does not carry a market value of interest. So we'll have to figure out the imputed interest, and the person that passed the money on, that supposedly loaned the money at these below interest rates, will have to pay the tax on the difference between the statutory rates that they're using here and whatever rate they charged. Okay, even if if the rate was zero, then it would just be that difference. So the difference between the amount that would have been charged at the federal rate and the amount actually charged. Now it applies to gift loans made out of generosity, affection, love, whatever. Okay. It is for compensation-related loans that these rules apply between employer and employees, and for corporate shareholder loans, okay, where we make loans to our shareholders. And then if we just simply have a tax avoidance loan, when I think this thing with well, I guess it could be love and affection between the son and the daughter and the father up here. Okay, so we could have tax avoidance loans where we just make the loan to try to avoid the tax. Okay, so you come over and you take a look at the imputed interest here, and we're going back to that example 34, and the federal applicable rate is 3.5%. From June 30th and through June 30th, I should say, and then from July 1st to December 31st, it's 4%. Now you take a look here, and Kareem made the loan on January 1st. The loan is still outstanding at December 31st. Kareem must recognize interest income of $51,140, and what's her name? Vanilla? No. Vania? Okay, interest expense of $15,140. So it's an expense to the daughter. It is going to be no idea why that happened. And it's going to be interest income to the father. So how will he calculate that? Well, for half the year, we use the applicable rates, 3.5% and the 4%, times what? Times the 400,000, and then we actually take what? We actually take the interest from the first part of the year and add that to the principal amount to calculate the interest for the second half of the year, and we do it in 6-month increments here, and so we've got this $15,140. Now, if the father had charged 3% interest, then the interest that would have been charged by him, it was 3% for the entire year, would have been $12,000. Now he has to pay tax on what? That increment, the 3,140. So obviously, if he doesn't charge any interest, it's just whatever the federal rates were that were applied to that. If he charges some interest, then it's the difference. Okay. Now, when you look at this, again, I think it's important to look at this slide from the standpoint that what? The lender has what? The interest income. It's seen as a gift that's been made. The borrower will have what? Interest expense, and it is seen as a gift received for any interest they pay. For the compensation related, it is considered interest income and compensation expense for a corporation, for an employer, I should say, lending to the employee. For the borrower, the employee, it is seen as interest expense and compensation income. Corporation, interest income, and they consider it a dividend paid, which is a little bit problematic because what? Dividends are not an expense, right? Therefore, we can't take them as a tax deduction. So if you're doing that with your shareholders, you're not going to get any sort of deduction for that. For the borrower, it is seen as interest expense and dividend income. Okay. Now, like most of the things, there are exceptions. Okay, so they start putting exceptions, and it's basically saying if you have what they call a de minimis loan, which they consider to be $10,000 or less between individuals. This is for our gift situation, made out of love, affection, right? Unless the loan is used to acquire income-producing property. Okay, so you can loan up to $10,000 and not have to impute the interest unless the money is given and they're going to purchase some kind of income-producing property. But we're going to see even for income-producing property, they still give us some nice exceptions under there up to certain amounts, up to $100,000. Now, when we talk about income-producing property, okay, we talk about what? When we have held it for property for what? Renting, leasing, price appreciation. Okay. When we talk about these properties, they could be residential or commercial. Okay. When we talk about residential, we're talking about non-owner occupied. So you've held this for some sort of investment. Question, guys? Is there a question? Okay, so in the process, if the proceeds, I should say, of a loan are used to purchase income-producing property, then we have another set of limitations. So if it's not income-producing, we're limited at the $10,000, right? If it is for income-producing, it can be loans of $100,000 or less. Then the imputed interest cannot exceed the borrower's net investment income. Now, when we talk about investment income, we're talking about what? Amounts that are invested in stocks, in savings accounts, those sort of things. We're not talking about the income from a business. Okay, so we don't consider that investment income. So it's basically all investment income less related expenses is the net investment income. Okay. Now, in addition, the net investment income for the year does not exceed $1,000. So if there is no investment income of $1,000, then we don't have to. We only have to pay amounts over a tax on amounts over $1,000. Okay. Now again, it is for what? Loans of $100,000 or less. So if it's more than $100,000, those rules don't apply. And of course, anything that's done for tax avoidance, we're not going to get any of these benefits. Okay. So you come over and you take a look at these examples here, and we have assumed tax avoidance is not the principal purpose of any of those loans, so they're taking that off the table. The loan to Susan is not subject. Well, let's look at Susan's loan. Susan's what? Got a loan under the what? under the 8,000, it is what? Not for business purpose. It's for the um, for investment purposes. It's what? For education. So she's okay. Okay, she don't or I guess whoever borrowed the money, or whoever loaned the money, Vicky does not have to pay the tax on them. Okay, Dan's loan is for what? Is for 9,000, but it's purchase of stock, so it is not going to be subject to the 10,000. But we have that what? We have that 100,000 stipulation, don't we? Okay, so when you look at Dan, because Dan's proceeds were used to purchase income-producing assets, the 10,000 limitation does not apply. However, the 100,000 exception comes in, and it would be the imputed interest would be limited to what? To his investment income of 500. But then we also have what? We also have this 1,000 exception, so we end up not having to pay. Vicky doesn't have to pay any tax on that loan to Dan. So she couldn't get him in under the 10,000, but what? We get him in under the 100,000, and then we don't have to pay any tax if we're up to what? This $1,000. Past 1,000, then we would have to start, paying tax on net investment income in excess of the 1,000. Okay. Now look at this next loan to Bonnie, and it's for 25,000, and it's to purchase a business. Now this gets a little bit funky because they sit there and they don't consider the purchase of a business love or anything like that. So they're kind of saying, well, it's actually what? For a investment, but they don't consider the net income of the business to be investment income. So that gets a little bit weird. So we can't get this loan under the 10,000 stipulation. We can get it what? Under the 100,000 stipulation, and sometimes the problems will go ahead and call out what the net income of the business is. That is not considered investment income. Investment income is what? Money that grows while you're sleeping. You've made investment in stocks, those sort of thing. Okay. Okay, so you look at this one, and we say no interest is imputed on Bonnie's loan because the 100,000 exception rule applies, and interest is so that's it. We're under the 100,000 exception, and they don't give us the net income of the business. But we're going to look at a homework problem where they will. That's not considered investment income, so we'll ignore it. Okay. Now, when we deal with Megan, Megan's loan is what? Is 90,000. And she's got what? She's got this investment income, and she purchased a residence. A residence would be considered what? Investment income. Okay. And so what happens? She comes down, and the imputed loan on Megan is based on the lesser of the 15,000, or the interest that is calculated by applying the federal rates. Did they ever give us the federal rates in here? At the end, they give it to us? Okay, great. Federal rate is 10%, right? And so what happens? We do it in 6-month increments. It's what? 10% for the first half of the year. We then go ahead and add the 4,500 to the 90,000. We do the second half of the year, right? Okay, and we have this 9,225, and because that is less than the 15,000, we pick up the lesser, right? The lesser of the net investment income or the imputed. Okay, now Olaf, what happens? He cracked the 120, right? So we've got no ways of sitting there and getting him out of Vicky out of having to pay the tax on this. And so what happens? We go ahead and we just impute the interest. Sorry, Olaf. None of the benefits apply to him because that loan is too big. Okay? Okay, good. Let's go ahead and take a look at the next slide and a couple more things. 10,000 exemption also applies to the compensation related in corporate shareholder loans. So all of the 10,000 requirements that we talked about will apply for those two categories as well. So remember, we had what? Love and affection loans. We had the what? From the employee to the employer and the corporate to shareholders. We would apply the 10,000, not the 100,000 rules there. Okay, and then there are no exceptions if the loan was done for tax avoidance. And no one's going to put on their tax return, I did this to avoid the tax, right? So, I mean, this is basically the IRS reaching and saying, we have the right to say to you whether we think it's for tax avoidance, and then we'll take all this away from you. Okay? Okay, good. Come over and let's take a look at annuity income. Okay, I think you all know, you got this far, what an annuity is. It's a stream of payments that'll come out, and it's becoming less and less fashionable to buy an annuity the way they're talking about here in this requirement. So most people these days are not going to want to go to an insurance company and say, here's, $200,000. Go ahead and, continue to pay me $1,000 a month for the rest of my life or something like that. People just don't want to cough up that money, and then they go and they get hit by a bus later, right? And you walk out of the annuity office, bam, you're dead, and you just gave up $200,000. So people come up with better ways to sort of shield that outcome than using these annuities these days. But let's just go ahead and let's take a look. If someone does that, a person will pays a fixed amount for the right to receive a future stream of payments. Okay? Just like in my own personal situation, they have what they call the thrift savings plan when you work for the federal government, and you can take that money out and buy an annuity, or you can leave that money when you retire and just draw off of that money, leaving it with the federal government. What do you think I'm going to do? Just leave it with the federal government. There's an endless Christmas tree of what? Taxpayer monies and what? Employees paying into that when they get money withheld from their paychecks. Why would I take that money and do what? Plop it down on an annuity, and then if I die the next day, the money's all gone. Meanwhile, you just sit there and you do what? You can keep that nest egg in with the plan itself, and you just collect money out. When you croak, if you die, then the money goes to whoever you've named as your beneficiary at that point, right? And there's something left over for them to throw a party with after you're dead. Okay, so anyway. Okay, so again, I just look at this. I'm like, okay, most people aren't going to do this anymore. But let's just look at the tax consequences when you buy this annuity. The insurance company will invest the amounts received from the annuitant, and the income earned will increase the cash surrender value of the annuity. So as that money sits there and they put it in, there's interest paid on that, and it'll grow, and at some point you can cancel the annuity and get the cash. Now, no income is recognized by the annuitant at the time the cash value of the annuity increases, because the taxpayer has not actually received any income. Again, they would have to cancel the annuity to get that money. That's a substantial limitation. Remember, we talked about that last time. So as it grows, you don't have to do anything. So Jen, age 50, pays $30,000 for an annuity contract to pay her $500 per month, beginning when she reaches age 65 and continuing until her death. If Jean should cancel the policy, I'm just going to do that in one color, she would receive $30,200, because I guess the cash surrender value of the annuity has increased in her gross income. However, if she does not cancel the policy, the $200 increase will not be included in her gross income, because she did not actually receive the $200, and having to cancel the annuity to get the money is considered a substantial limitation. So we wouldn't have to take that for the increase. Okay. Now, what happens is they start to pay. Well, as they start to pay, we will have to apportion the payments out, and some of it's going to be recovery of capital, but some of it is going to be what? Considered income, because you have what? Grown in value of that annuity over the years until you started drawing. Okay, so the annuitant can exclude from income the recovery of capital portion of each payment that the investment in the contract bears to the expected return under the contract. Okay, so how are we going to figure out the exclusion amount? And the exclusion amount we'll put the initial investment in the numerator here, and then in the denominator we'll put the expected return. Okay, and the portion of that expected return that is constituted by the initial investment is the amount, and we'll multiply that times the payments, is the amount that could be excluded, because we're basically saying, hey, some of that money is what? Part of your initial investment. Some of it is an amount that's being paid out because there's been an increase in income here. Okay, now you come over and we take a look, and we have this $10,000 paid for the annuity, and it'll pay $1,000 a year for a term of 15 years. Life expectancy is 15 years. And then we have the exclusion ratio for A and B situations. So it could be for a term of 15 years or for a lifetime, which if it's expected to be 15 years. And so we go ahead and we have the 10,000 they initially put in. And in the denominator, we have the 15,000 that they're estimating they'll receive, either because they think the person's going to live 15 years, or they think that what? They think that, well, the term is for 15 years, and they're going to stop paying after 15. Okay? So we come over, and we take a look, and if it is a 15 years of annuity payments that are made, okay, in years 1 through 15, $333,000 is going to be taxable, and 667 is excludable. Okay, I thought they showed us the calculations here somewhere. No? Okay, so let's just go ahead and remind ourselves the numbers were what? 10,000 divided by 15,000. Okay, so they would have taken the 10,000. Where'd my? Let's do red. They would have taken the 10,000 divided by what? 15,000, and then they go ahead and they get the what? The 1,000. What was it? 1,000 a month. And so they go ahead, and that's how they came up with the portion that is excludable is the 667. Maybe you guys saw that without me having to write in these calculations. The 667, and the remainder of that 1,000 is what? Includable. Okay, and that goes on for years 1 through 15. Now what happens? After, if you beat the odds, okay, and you continue to live, in this case, the person beat the odds by 3 years and continued to kick on for 3 more years, then what? In years 16, was it 16, 17, 18? Yeah, 3 more years. That person would what? Be paid tax on that entire amount, because now they've received an amount in excess of the expected distributions. Okay, now if you happen to be so unlucky that you don't make it the 15 years and you die after 10 years, then what? Then again, in years 1 through 10, since they didn't know you were going to die, okay, too soon, then you would have that same includable and excludable amounts. And then in your final tax return, okay, the one that they file after you die for you, is going to take that that amount that was included as taxable, the 333, and it's going to go ahead and multiply that by the 10 years that you had actually paid tax on amounts, assuming you were going to get what? 15,000, but you didn't actually get it. And so for those years, you get a deduction on your final tax return of the 3,330. Okay. So the goal is to do what? Not die there. Okay. So you live more than 15 years. Yes, sir. Well, I mean, we don't hold a seance or anything. Somebody's going to file the return. His accountant, his attorney, let's say his wife, his kid, whatever. Okay, someone has to file that return. Is that your question? Yeah. So someone will file. You got to file one last return. Okay. Otherwise, they don't let you in heaven. You're standing there at the door. Let me in. They say, well, did you file your taxes? No. They pull the lever, down you go. Okay, so you got to file that last return. Okay. IRS will get you one way or the other. Okay. Now you come over, and you know what they do? You know what happens to you in hell? You've got to come to, UGBA 121 every day for the rest of your life for 8 hours a day. It's awful. Okay. Okay. All right. Enough with the jokes, John. Okay. Let's take a look at simplified method for annuity distribution. It has to be from a qualified retirement plan. Okay. And now exclusion amounts are basically based on your age. And you will go ahead and divide these amounts by the monthly payments that are listed on this table. So you go ahead and you take a look at Andrea, who's age 62. That's age 62. Let's just see how the table works. Andrea, age 62, receives an annuity distribution of $500 per month for life from her qualified retirement plan beginning January 2016. Her investment in the contract is $100,100. The excludable amount for each payment is $385, which they got by taking what? Since she's 62, she's got to use that 260 factor, and so the 100,000 divided by the 260 monthly payments, and thus 115 of the is included in her gross income. She gets to exclude that 385, which was basically we came up with dividing the number of months times the that factor, the number of payments by that number of monthly payments factor. Okay. Did that math work out? I don't know why that looks weird to me. 100 divided by 260 should be 385, right? That math works out? Somebody got a calculator? Yeah? Okay. This looked a little weird to me. Okay, good. Now you come over and let's take a look at prizes and awards. So let's say you win the Nobel Peace Prize. Okay? If you win the Nobel Peace Prize, Pulitzer Prize, Faculty Teaching Award. Gee, I wonder who put that in there. I didn't put it in there. Okay. So you win these things, prize or awards received in recognition of religious, charitable, scientific, artistic, all of these, you would not have to include the value of the award in your gross income. Okay. The recipient can transfer the prize or award to a qualified government, alumni, or nonprofit organization. So let's say you don't fall in these categories and you don't want to pay the tax on it, essentially. You just give the award over to a nonprofit organization. Okay? Now, they'll let you do this if the taxpayer does not itemize deductions. Because what's happening? You go ahead and you say, oh, okay, I don't want this. I'm going to give it to UC Berkeley, whatever, right? And then what? You take the charitable deduction because you've done an itemized, then you've gotten a tax benefit off of that, right? So they're going to say, no, include that in your gross income then. Okay, even if you do give it over, you'd still have to include it. The taxpayer's charitable contribution exceeds the annual statutory ceiling on deductions. So if you don't itemize, it's okay. Or if you've already exceeded the cap on charitable contributions, then you're not getting any tax benefit out of it. So they say, okay, it's all right. Go ahead. You can exclude that from your income because you're not getting a tax benefit. Also, and here they kind of help the taxpayer out a little bit here. They say, you know what? We'll still let you exclude if you've made the charitable contribution, as we've set up there, or if including the award would cause you to have a adjusted gross income that is too big, that limits your ability for other deductions, such as the medical deduction that's based on AGI. So the person says, geez, I don't want to include it because if I do, my AGI is too big and that's going to limit my ability to take other deductions. Then they say, okay, that's all right. Then you can go ahead and exclude it to avoid that unfavorable outcome. Okay, now you come over, and it's any one of those guys. It doesn't have to be all of those, obviously. It can be any one of those. Now, if you won the award and you didn't apply for it, you were selected without any action on your part to enter the contest or proceeding, then you don't have to include it. The recipient was not required to render substantial service. Okay. Now, taxpayer can avoid including prizes and awards in gross in by simply refusing the award. Another exception is provided certain employee achievement awards, such as a gold watch. Okay, you worked for us for 40 years. We ground you into the ground. Here's a gold watch, right? Okay, but again, there's a ceiling on that. There's a stipulation, it has to be based on length of service, and there's a ceiling of $400. And then I thought this was kind of cool since the Olympics are going on. You don't have to include the value of your gold medal, okay, when you win the luge contest. And you can exclude cash award with amounts up to $1 million. Do they give you I don't think there's any cash that goes with it. I think it's just the gold medal, huh? Well, yeah, endorsements, but that wouldn't count with this though. Do they get $1 million though? Is it 25K? Okay, I was thinking 25 for a gold. Okay, that's not too bad. 37,500 for a gold medal at the Olympics. Okay, I mean that's great. And then what? If you sell the medal, what's that worth? Another 20,000? You should be in good shape. Okay. All right. Let's go ahead and let's wrap up the slides here, guys, and take a look at group term life insurance. And we have premiums, okay, on the first 50,000 of group term life insurance are